The real benefit to a Roth IRA is seeing, hey, I'm putting money in. Yes, I'm biting the bullet and paying taxes now, but I'm going to see this grow over several years. And that's an opportunity to then have a much larger amount come out tax free and ultimately minimize your lifetime taxes.
All right, this is the video that the majority of the people on my channel have been waiting for. And this is the video that we are going to talk with our financial planner, Taylor Demars. And I don't know that we're going to get to all of the questions, but we're going to try. And if we don't get to them in this video, we will either answer them together again in another video, or we'll take turns on our channels answering some of the questions. But there were lots of questions. But before we get to those, if you would tell us a little bit about yourself.
Thanks, Melinda. Excited to be on here. I love your channel and excited to get some value for your audience here today. So my name is Taylor Demars. I work for a financial advisory firm called Demars Financial Group. Actually, next year is our 50th anniversary as my grandfather started this business. So I get the opportunity to be third generation. I work with my father today, and we do comprehensive financial advising. We primarily work with retirees, so folks like yourself. I think it's a very specific phase of life. So that's our specialty. And we really mean that we're comprehensive. We don't just talk about the investments or just talk about the pensions and annuities. We even do tax preparation in-house. So we try and have a really holistic view when it comes to one's finances because everything's interconnected. So excited to be talking about those type of things today. And it may be worth mentioning, Melinda, or at least for your audience, is I love the questions that I've been seeing from your viewers and want to just give a heads up that personal finance is very personal, right? And so as I will do my best to give answers that will be satisfactory, many different answers could come up for every specific person because there's just so many nuances depending on one's age and health and income and family scenarios, just to name a few things. So I'm happy to give as much information as I can, or if people have one-off questions, I'm happy to field them on a personal basis as well.
And I will include like your contact information in your channel. So if people want to reach out to you after they watch this, they can. But I too have learned over getting to know you and my own research in financial planning. I wanted black and white answers to my questions, and teachers are rule followers. And a lot of the people that have submit questions work in the education field. So there's a little bit of they want a black and white answer to their question, and then they are rule followers and they will follow like every rule. So I just wanted to put that out there because my audience knows I have never met with a financial planner. This is it. You're the
Sure,
first one.
sure.
And I may or may not be that great with my budget. I've also talked about that on my channel. So some questions may be steered towards those things.
Sure.
But we both wanted to set the stage for if there's any ambiguities or anything like that in our conversation. But our first question is,
Sure.
how much does it cost to meet with a financial planner?
Great question. I think the first way to answer that is what type of relationship are you looking for? Some people may be looking for, hey, I just want a second opinion, right? Just check my engine, right, of my car, see if everything's looking okay. That's considered a one-time planning fee, and I can't speak for all financial advisors out there, but probably a healthy range is to look for someone that's charging no more than $1,500 to $2,000. And I should say, as you're looking to explore with a financial advisor, there's enough of them out there that you should find someone who meets your specialty. Don't look for just like a general practitioner for a doctor. You wouldn't go to them to ask about a knee replacement, right? You'd seek out a specialist. So try and find an advisor that is curated to your specific needs. Another way to meet with an advisor is hourly, not as common out there, but that is one option that people could find if they're looking for a low commitment relationship. And that could cost anywhere between a couple $100 an hour to several $100 an hour, just depending on how many questions and how much complexity you have. And then there's also flat fee advisors. So they are more of like a retainer basis rather than charging per question or per project or per hour. They just have an annual type fee. And that also depends on what level of complexity your household has. And that can cost usually around $8,000 to $12,000. I know that's a relatively big range. 8,000 if you're single and you have a relatively straightforward financial situation, and obviously more complex, more expensive. And then the last type of way to meet with an advisor, a way they would charge is what's called AUM, which stands for assets under management. Also, a fee based relationship where the fee is based on how many assets you're having them manage for you on an investment basis. That's how our firm works. And we find our clients like that because it puts our incentives on the same side of the table as them. A lot of retirees, their number one concern is running out of money, and they like knowing that our income is directly related to that concern of theirs. So, A, our job is to make sure they don't lose money, and B, is to help it grow over time. So, that's the way that we work with our clients, and it's on a sliding scale based on their level of complexity.
So I wanted to clarify, you have to have a good relationship with this person, I think. So if you meet with someone or you have that initial consult or meeting and you don't think you're going to mesh with that person or you don't understand what they're saying, you can't get them to clarify it in terms that you understand, then that might not be a fit for you. So it sounds like you have to find a financial planner that is a fit, like your doctor, like someone that you feel comfortable talking about these things with over time.
I definitely agree with that. I think it's a very intimate relationship in some ways, which for that reason, I really enjoy my job because it's more than just dollars and numbers on a page, right? We're talking about people's life savings and the way they make decisions. And you're right, there has to be a level of chemistry, in my opinion, with the person that you really need to fully trust because I can't help someone with things that I don't know about, right? So if they're trying to hold their cards close to the vest, they're only hurting themselves if they're really looking for feedback. Just as you go to a doctor and you want a good prescription or recommendation, you better be sharing your full medical history if you want to get the best feedback possible. So you're right, you do want that good relationship. I do suggest shopping around, talking with a number of advisors. I even curated a list of the top 10 questions to ask when you're shopping around for an advisor. So I can give that link if you want to include that in the description for people to reference. But definitely think it's worth kicking tires to get around. And many advisors, myself included, start with low pressure or no pressure, I should say, introductory call, just 15 minutes to say, hey, are we a fit for you? What, based on your goals, what you're looking for, let me help you find someone that is. And after that, they may say, hey, let's have an introductory, meeting and get to know you on a deeper level. And I personally don't charge for that because I want to, like you're thinking, help people discover whether we're a fit or not. And if not, then we part ways as friends.
So, to piggyback off of that, are there different types of financial planners? Like, what are the different types?
Good question. I would say that boils down to, again, how they're paid. There are what people call commission based advisors, and there are fee based advisors. So, those commission based advisors, they're more of the legacy type of advisors that may have given the industry a bad rap because they're more sales oriented. And that's just the way the industry was. The way that those advisors work is basically trying to sell you something and they get a good commission for it, a one time commission. And then, frankly, they don't have an incentive to work with the client thereafter. So, if a person has a question or they have trouble, sure, if you have a good advisor, they might help you, but they're on to the next hunt, right? Our business is a fee based relationship because you're paying the advisor. Me, I don't care what type of investment my clients work with or what products they choose. They pay me for my advice and feedback. And that's what I would suggest to people to seek out somebody that they have that type of relationship with rather than worrying about whatever conflicts of interest that advisor might have when it comes to, oh, are they trying to sell me something or pressure something on me? So,
So that leads me to my next question. If we choose to work together,
mhm,
then how many times do I meet with you? So I choose to work with you based on what you offer,
sure.
and we sit down and we have our initial meeting. Then what happens? Do I freak out over my investments for the next 6 months and just hope that you're taking care of stuff? Is there like a way that I can see what's going on?
Good question. I think when it comes to advisors in general, there's a number of different ways you could answer that. So if you don't mind, I'll just speak to how we would answer that for our own firm. And the short answer is we want an ongoing and consistent relationship with the client. We don't have any reason to meet with them multiple times so we can raise our fees. It's simply so we can do our best job for them. And the reason I like our style of working with clients rather than a commission based is we're incentivized to work with the client literally for life. And I get to work with clients that started with my own grandfather and my dad and now me, and they'll probably be a client until they die. And that's the type of relationship I like because it's more enjoyable and I get to help them more. Be able to say, oh, remember when Johnny graduated from college and now we're talking about how do we help him buy his first house. And that relationship just evolves and grows on itself. The initial relationship has more meetings, I would say, depending on the level of complexity and what's going on, just to answer questions. Maybe they got an inheritance or are consolidating accounts or selling properties. Yeah, we want to meet as many times as we need in the first several months in order to get that all figured out. And then once things are on a more consistent or calm basis, I'd say I like to meet with clients twice a year. I like to meet with clients in the spring time frame. So right after tax season, taxes are done, top of mind, right? They bring in their tax return. We're able to analyze, do some tax planning and planning for the rest of the year. And then an opportunity to meet in the fall, 6 months later, to say, hey, we've got most of a year's worth of income, so we can implement some tax planning. And then as well as just do our regular checkups and feedback. If people are looking for a deeper dive into what actually comprised those meetings or focuses, I can share another link or document that people are shopping around of what actually do you talk about in a client meeting and what's going on behind the scenes when you're not actually meeting with your advisor. What are you paying them for, even though you're not sitting in front of them? But the way I would
Okay.
sum it up for you, Melinda, and the audience is you want to try and have that relationship with your advisor as you would with your doctor, your primary care doctor. You have regular checkups, regular physicals, right? Something small, something big comes up. In all those cases, you're wanting to be on the same page as the doctor so they can help you as best as possible.
That was good. All right. So
Little
this
long,
is kind
sorry.
no, this one might be your long one. I'm not really sure, but here
Okay.
are the words and the things that I've heard and or been offered over the years as an educator. And you sign up for a 15-minute spot to meet with a financial person, and then they offer you some of these things. So you have 15 minutes to decide how much and what you're going to put in whatever this is. So there's
No
a
pressure. Yeah.
401k, a 403b, an annuity, a Roth IRA, and a mutual fund. And then I'm sure on top of that, there's like stocks and bonds and all that kind of stuff. But those are the words I think in education that we've heard. Can you tell me what those things are?
Definitely. And I'll try and sum it up with a bit of an analogy that I like to think of is you may hear things like 401k, 403b, Roth IRA. They're technically called vehicles. They're just different types of accounts, right? And each of these different types of accounts could hold the same investments in theory, right? Like an ExxonMobil or an Apple stock, right? You could put them in any sort of one. What's the difference is how they are taxed or treated. 401k and 403b are pretty darn similar. They're just names of the IRS code, is why they're called that. The 403b is probably more common for your audience because that's usually for educators. 401k is more for other corporate employers. They both mean they are a retirement designated account and usually are where pre tax funds go. What does that mean? Another way of putting it is tax deferred. So when someone says, I'm putting money away in my 401k or my 403b, they're putting money aside and they don't get taxed on it. The IRS, the government incentivizes people to put money aside for retirement by saying, hey, you don't have to pay taxes when you put this money in. Cool. What's the catch? The catch is as it grows and when you finally take it out in retirement after age 59 and a half, then you pay taxes on the full amount, right? So maybe you put, say, $10,000 a year in an account, and then it grows. And by the time you retire, that $10,000 is now 15,000 to make the number simple. That entire, every single dollar that comes out is now going to be taxed at income tax rates. So that's what a 401k, 403b is. A Roth IRA is also a retirement account, but it's different in the sense from taxation that as you put money into the account, it does get taxed. So no tax break on the dollars going in. And you'd say, what's the benefit of that? Why would I chase that? And the reason is because as it grows, and when you ultimately withdraw it in retirement, every dollar is tax free. I like to think of it as the difference between paying taxes either on the seed that goes in to the ground. That would be like a Roth IRA. You're paying taxes on a smallish amount. Relative as it grows and it becomes, say, an orchard of funds, you're no longer paying taxes on the orchard, right? The 401k, 403b is the opposite, where you are not paying taxes as it goes in. And then as it grows, you do pay taxes on the orchard. So the next question people usually have is, which is right for me? What should I be doing? And this goes back to the personal question to say it depends on a number of things, such as where's your income tax bracket, right? Are you in the 12% marginal bracket? These are federal levels, or 22 or 24, et cetera. Because the higher bracket you are, the more expensive and less attractive the Roth option is, right? And if you're in the lower brackets, then you may justify paying the taxes now. And the other question to ask is how much time am I going to see this money grow inside of the account, right? That's a consistent goal I try and have is how do we minimize my clients' lifetime taxes? So hopefully that gives you a bit of a flavor, not too much detail to overwhelm people about the difference between these different types of accounts. So annuity is a different animal in of itself. Some people call it an investment product. I consider it actually an insurance product because what an annuity is a guarantee of income. And people like the word guarantee, especially when it comes to income and retirement. But there's always a catch. And I'm generally not in favor of annuities for my clients. I think there are better ways to achieve the goals they're looking for. But annuities tend to be expensive. They're expensive up front to buy them, and many people overlook the ongoing expenses to have an annuity. And the other thing is that it has a lack of flexibility to it. So when I'm talking with clients in retirement, they want to say, "Oh, I want to, plan a vacation this year, or I want to transition homes this year. Or I have this lump sum expense or that." An annuity, for better or worse, is fixed, like your pension, right? That you experience, Melinda, which is a great thing to
Mhm.
have, that you have a guaranteed amount of income every month. And an annuity is the same way. The catch is you don't have the flexibility to say, I want to take out more this month than I did last month, or I want to set up the investments differently. It's for most annuities, and not all annuities are the same. It's more locked in and not all on autopilot once you annuitize. So that's a bit on annuities, and there's a lot of nuances on that I probably don't have time to get into. But the other question you asked about was mutual funds. And mutual funds
Yes.
are a type of investment that can go into a 401k, go into a 403b, a Roth IRA. Each of those were vehicles, and you can put different types of investments into each of those vehicles, such as a stock or a bond, or another term people may have heard of is an ETF, which is exchange traded fund. And I can go into those on a deeper level if you like, but in short, those are the types of investments that can go into the different investment vehicles you asked about.
That is very helpful. Again, like I
Sure.
said, when you're in education, my experience has been central office sends their financial person of the year over. You sign up for a 15-minute spot during the day when you're busy teaching and doing all of this stuff, and you have to make a
Yes.
lifetime financial decision in 15 minutes.
Yeah.
People will take whatever that person says. It's just the worst way to set up a teacher for success. It just would need to be more than that. And I see these young baby teachers right out of college, they don't know, and they have no idea what financial planning looks like, or if their district is going to have a pension. And then again, they get 15 minutes to decide what they're going to do and make this life decision. So that was
Yeah.
super helpful.
No, happy to help. And yeah, 15 minutes, it's pretty short. Even if it is the best option at that moment, it's a consistent process. You got to check into your plan, even if you're doing it on your own, like, and make sure it's on the path you're looking for because life happens, goals change. That's what makes my job fun is it's always changing depending on each person's situation.
My next question is going to be, what is the difference between the pension? I get a retirement check from the public school retirement system the last day of the month, every month. It's going to be the same forever. What's the difference with retiring with investments? So, if I had investments instead of a pension, or if I had investments along with my pension, how do I get my money? Do
Mm,
you, Taylor, write me a check? Or how do I get money to live on if I am using my investments?
Great question. Yeah. And you summed it up well. The pension side is the simpler answer, right? Because it's on autopilot. It comes out certain day of the month, and no matter what's going on in the economy or the market. And that's some great peace of mind to have as you knowing it's coming out every month. It's likely also having some taxes withheld for you on both a federal and state level. So that's an important element. I don't know how your pension is set up specifically, but many people have also additional amounts taken out for potentially Medicare or health insurance. Now, the investment side is where it gets a little more fun and complex because it just depends on how each person's situation is set up. And so with most of my clients, they have a variety of different accounts. So we talked about like the 401k. I should say an IRA is very similar. And so a 401k can be consolidated into an IRA. It doesn't cost taxes or fees to do. So they could have an IRA, a 401k, they could have a 403b, they could have a Roth IRA, they could have an HSA, they could have a traditional brokerage account, which just means it's not a retirement investment account. And when you have these general different types of investment accounts, you could have, going back to what we said before, you could have the same investments in every single one of them, right? The real difference between each account is how they are taxed. So that's where it comes down to answering your question is, okay, how do I get the money out? And for me, when I'm advising a client is to say, how do we minimize your taxes? Because that's oftentimes a retiree's single largest expense. How do we minimize those taxes? And it depends on, okay, what are your other income sources? Do you have an annuity, a pension? Have you started Social Security? Are you working a side job like or subbing like you are? I'll boil it down to just a strategic way of withdrawing funds, depending on how much you need and where you want to land tax wise. For us, we, for example, manage our investments for clients at Fidelity Investments. We manage about $260 million of assets on their behalf. And no, I don't write them a check, but we are the facilitator to help them get the funds from their account to their bank account. So we set up what's called standing instructions. So I'll set up from their Fidelity account to their bank account or credit union account of choice. And then assuming they're wanting money on a regular basis, like a pension, we'll say, okay, you need, say, let's call it $5,000 a month. We'll also talk about withholding because no one likes surprises come tax season. So we'll say, depending on your tax situation, we'll withhold X amount for taxes. So they don't have to do anything. We do that for them. We withhold it and send it to the IRS on their behalf. And then they'll see that net amount, same as you, arrive in their bank account every month, the day of their choice. Same thing could happen if they say, oh, I have a lump sum, a one-time amount that I want to take out from one of my accounts. It's the same thing. They would give us a call or an email. We would get the money from one account to another. But for an ongoing basis, the way to summarize that answer for you, Melinda, is we determine based on their tax situation, their income sources, their goals, their income needs, where and how much to pull from each of their variety of investment accounts, make sure there's taxes withheld for doing so, and set up the connection to their bank account to get it deposited every month. And then meanwhile, in the background, it's my job to make sure that the investments are managed in a way to A, meet their investment goals, but B, have enough cash available. Because I need to be able to sell the investments because you can't take an Apple stock and put it in your bank account. I need to make sure that I can sell the different investments that they need to have the cash available to then make it to their account by the 5th of every month, for example. Does that
Okay,
make
so
sense?
just to clarify, I'm not telling you what bucket to take my money out of as a financial advisor. I basically know what my buckets are and know what I need a month, and you determine the buckets and the moving around behind the scenes.
That's a good way to summarize it. That's what you're paying me to do, right? To help make those strategic decisions. And I can only help as much as a client, again, is transparent with me. So when I work with a client, I do my best work when all of their assets are consolidated under our management. Because if they're saying, hey, I want to get money out and I don't know what's going on with their other 401k account or IRA or whatnot, I don't know how it's invested, if it conflicts with their overall strategy or what we're doing for them or how it affects their tax situation, much less, hey, is that an option that we want to integrate into our withdrawal strategy? So, yes, to answer your question, it is my job to make those hard decisions for the client so they don't have to worry about it.
Okay, I do want to ask the last question,
Sure.
and it is, and we have more questions, like there were more questions submitted than we can cover in a decent amount of time
Sure.
that you're not sitting in front of your computer forever. So there are more questions to answer, and Taylor and I will figure out a way to get you the answers, whether it's us doing another interview together, him answering them on his channel, me answering them with his information on my channel. There are more questions, but there were so many, we just don't have the time to get through all of them. But one that came up a few times was about long-term care and how do you plan for long-term care. I watched a video provided by our retirement system about long-term care, and if I can find it again, I'll link that one too. But that was the Missouri State Retirement System. But how do you help people process the thought of long-term care?
Great question. Yeah, that's a big bucket of worms. But it's a relevant one because I feel like it's a potential torpedo to my client's finances. At the end of life, just this missile comes in and can sink the whole battleship, right? Because it gets very expensive very quickly. I just met with some clients the other day in town that their costs were over 20,000 per month, and then they weren't in some palace. They were in an apartment of a facility, and she needed regular care and he really didn't. But that's just what it costs nowadays, and it's not getting any cheaper. So, long-term care, many people ask, should I have a long-term care policy, or if I have one, what should I do about it? Again, depends on your personal situation, but I have yet to see a client of mine with a long-term care insurance policy not see their raise at least twice. These long-term care insurers, when it first came out, they underestimated how long people would live and they underestimated how expensive healthcare costs would get, like everyone else. So they've come back to the policyholders and said, sorry, not sorry. We need to raise your premiums just so we can stay in business. So either A, you get to pay more to get the same benefits, or B, they have to lower their benefits just to pay the same amount. And it's not a very savory decision to make. For some people, it makes sense to hang on to it, others not. So for those that are considering letting go of their insurance or saying, oh crap, I don't have insurance, what do I do? I generally advocate, as I would otherwise, to get debt free. Pay off your house. Why? If you've paid off your home by the time that you might have to consider long term care, the harsh reality is for most people, if they go from their home to a long term care facility, they're not going to move back to their home, right? That's just the statistics. Women live around 3 to 5 years in a long term care facility, and men live 3 to 4 years, just on a general level. So for my clients, I advocate for don't panic if you don't have long term care insurance, because we, A, create a plan that they have enough investments to help get through that initial stage, and B, plan on selling your home. It may not have to come down to that, but it's definitely not a bad strategy to have to sell your home in order to unlock those potentially hundreds of thousands of dollars that will then afford that 3 to 5 years worth of expenses that could come up at the end of life. What I will say, another common question you didn't ask, but I hear come up is about reverse mortgages, which is saying you're not selling your house yet. You're just leveraging the equity in your home to get a loan. And that for me is like the bottom of the barrel of options. I really don't love them. I don't want to speak ill of any mortgage lenders out there, but I just feel that those that are really pushing reverse mortgages aren't looking for the client's holistic benefit. They're just trying to make a loan happen. And there are circumstances that a reverse mortgage can make sense if someone is trying to age out in their own home, but you really got to measure twice, cut once with that and get someone who's incentivized to see your best interest rather than just relying on the mortgage lender to tell you what to do. I would rather just see a clean transition where you either sell your home and you start renting. Maybe I've had some of my wealthiest clients, they sold their home and they really love just renting in a really nice senior community, however you want to call them. And he's not needing long term care, but it's a facility that transitions to that type of care and memory care if they need. So it's not like you're just giving away your identity or losing your dignity, as many of my clients fear for by selling their forever home. But I think what it comes down to is making sure that you can make the decisions you want to, and being able to sell your home gives you that flexibility. Does that help answer that question?
Yeah, that was great. And I've
Okay.
heard some of that, or I've been trying to research some of that just because my audience has been asking for it. But the more I hear it and the more ways it's explained, it just helps. So I will link that video that I watched from Missouri's retirement system in the description. I'm also going to link the information that Taylor has given us and his channel and his information in the description. So you can reach directly out to him to expand on any of the comments or questions that we've answered and talked about here. But as I look at my notes, I still have more questions about taxes, questions about taking money out, questions about is this considered income? Is this counted against me or for me? I have a bunch of questions that come up like that, so that we'll address those as well. It may not be right now, but we will get to those questions. But I just want to thank you for doing this. I know that I don't come from a very financial planned background, and I went way out of my comfort zone by asking a lot of these questions because
Good for you.
a lot of people can't believe that I retired with the situation that I'm in without a financial planner. And sometimes I think there's no way I would be able to do what they do because I don't have the resources. So I really appreciate you doing this interview with me.
My pleasure. I appreciate the opportunity, Melinda, and happy to answer any other questions that your audience may come up with.
All right. Thanks, guys.
Awesome. Take care. Thank you.